what we're trying to do here is actually, number one, educate the community. I think people feel empowered when they're educated, and then they can make much better choices, whether they want to use our platform or whether they don't even want to go down that road or something else. When you start educating yourself, once you get into a particular system, it makes it more difficult. I think when you educate yourselves initially, you have more choices and you can make better decisions.
Hello, everyone. Welcome to another episode of Test, Optimize, and Scale. I have Mo from EquiDeFi here today, dialed in from New York to talk to us about the world of venture capital, talk to us about SaaS platforms, how he is working with issuers through the SEC to effectively bring investors to deals. Mo, thanks for taking the time to join the podcast here. I've been looking forward to our discussion.
Jason, always a pleasure, man. Thank you so much for having me, but always a pleasure to see you and speak with you.
Absolutely. Absolutely. And how did you get into this world of Reg D, credit investor raises? What was your career path to get here and creating EquiDeFi?
Sure, I'll give you the super abridged version because we could probably talk the whole podcast just on that alone. So I started off as a proprietary trader, trading equities for E-Trade securities. Everybody knows E-Trade. E-Trade, I think, was bought out by Morgan Stanley. It's like E-Shares now. So while I was trading, I was kind of on one end of the finance world. I was trading securities. Look, it's typically what you would see, as a trader in the movies or something like that. 9 screens, hacking away. It looks like a big video game. And this was going on around 98, 99, 2000. After I left that industry, post the dot-com bubble burst, I went into work at a couple of law firms, and I was just kind of consulting for them, doing some legal assistant work and consulting for them. And that's where I got my first introduction to 33 Act, 34 Act deals. In other words, these types of private placement investments that were going on. So think of it as circa 2005. And I started understanding kind of in the primary markets, right? The markets that we're used to, Jason, is like, you open up your Fidelity or Schwab platform, and you see the hot stock of the day or something that you're following, some company you're aligned with, you buy their shares or you sell shares because, it's at a pretty good price. And that's kind of what we know, what most people know about the securities industry and stocks, if you will. That's kind of what I knew. And when I started working at this law firm, I started understanding a little bit more about how these high net worth people get in first, and get these securities like when they're issued by the company directly to them before it even gets into like the NASDAQs of the world or the senior exchanges like New York Stock Exchange. So I was very intrigued by what is the process of this, and how does it all work? Outside of the fact is how do you get into pre-IPO shares, right? It's like that sounds pretty lucrative to be able to do that. So I started really delving into that process. And then I opened up a transfer agency in 2010, 2011, because I was so intrigued by it. And it was really a part of that model to be able to help facilitate, the issuance of these securities on behalf of these companies that are public. And then we got to EquiDeFi later on because I was more interested now after learning all of this for 15 years. How can we help issuers be able to raise money and then help their investors get their securities in a much more streamlined way than what I saw 15 years ago in kind of a legacy way. And that's why we're here now. So I literally sort of went through the entire life cycle of what would be called a private placement offering or the issuance of private securities.
I love it. So you're trading. You're good at it. You're understanding how the ecosystem works.
Wouldn't say I was particularly good at it, but I did a little bit. Yeah.
I heard 9 screens. I feel like you get the 9th one when you're getting good. But
as long as I didn't buy them, it's cool,
But as you're understanding the space, you're looking into these deals that bring in accredited investors early. You're understanding the growth potential as that valuation, the market cap continues to increase around any one of these individual issuers. You create your own transfer agency around 2010. And as you're getting into this world of issuance, you're seeing all these inefficiencies and found ways to streamline for the issuers and for the investors and make it easy for them to find more deal flow for the investors, of the right entities and at the right stage, and to reach more investors and make it an easy process to get them to participate for the issuers themselves with your SaaS platform.
That's right. That's right. I'm a big believer, Jason, in staying in your lane. And I wanted to, with my business, stay in my lane. And that was part of the some of the test protocols that we're talking about as part of your podcast here is that, by staying in our lane as a transfer agent, we don't get outside of, what the guardrails we set as and what we need to do as transfer agents, right? Transfer agents need to do their KYC and compliance, all these sort of back end tasks. And I was like, well, if I wanted to have a platform that was different from a lot of the other platforms out there currently, as a SaaS platform for the for the investment side of the thing, I need to stay in my lane too, just like I do with the transfer agent. So what does that mean as a SaaS platform? Well, just be a software platform, be able to facilitate all of these different pieces that you can help the investor with, like for instance, compliance and payments and document production and management and execution, but don't get into the things that you do really well, Jason, like marketing. Don't be a broker dealer when you're not registered as a broker dealer. I can do all of those things. We could, but by staying in our lane, we can do what we do best, which is really streamlining something that I've seen for years that has been, sort of rife with friction. And by staying in our lane, we can really reduce the cost for the issuer. We can do all of these things which are valuable and necessary without sort of going over the top and letting the people that do what they do best plug into our system. And I think that creates not only efficiency, but it creates integrity with what your core value and core product is.
You can be a master at your lane.
Exactly.
I've definitely seen groups in the space try to take on too much and have kind of watered down offerings. You mentioned the broker dealer part. I've seen groups pretend to be broker dealers and try to stay away from those. That's a gray area in its own. But it sounds like you're able to reduce costs, create a better experience for your partners as well, and create this whole stack that makes it easier for the issuers. And yes, speaking from the marketing side, absolutely. That's actually language I use, try to stay in our lane. We don't try to field or entertain any legal questions, nothing on the accounting side. You need to speak to these individuals about compliance. We're going to target investors, bring them down a marketing funnel. Advertising, different data that's available to us. We're going after these accredited audiences and taking them to a series of content pieces online that get audiences excited. It showcases momentum, showcases traction, and that's what digital allows for, right? Is for scale. So instead of having one-on-one offline conversations, it could be hundreds a day that are happening, thousands a day that are happening. And I imagine that's why you created this whole stack. Is why limit it to, all your eggs in one basket? We're hoping to have this one group, this one individual come in. Now you can put everything online and potentially even have a stronger presentation. Nothing beats, in person, but you can encapsulate in a video what the pitch would look like. You can have all the information right there. Don't worry about following up over email. It's all in one centralized spot for prospective investors.
Exactly. It's in one centralized spot. And a couple of things come to mind when you eloquently put that, Jason. And that is, number one, we're a modular platform, right? And modularity is important because modularity is, speaks to the customization and nuances of the types of deals and offerings that you're doing. So as a compliance guy, and a compliance guy meaning that, running a transfer agency, compliance is always top of mind. But coming with that background, I'm able to say, hey, look, a Reg A plus offering workflow for an investor, has to include these items. And what we do is we go out to the broker dealer community, go out to the legal community to be able to vet that and say, okay, you know what, this is great. You have the right guardrails here. You have the right amount of little friction that's necessary. And you've used best in class technology to sort of modernize this. That's not the same for a Reg D, let's say 506C offering for accredited investors only. We need to have, a modular system, which adds, another sort of, which pivots, a little bit and adds that particular module necessary for a Reg D 506C. And I think that modularity is important because, number one, to your point, it maintains integrity and that customer experience that we value.
Yes.
Number one. Number two, it has the correct guardrails, right? Because, a lot of people like to say that, okay, once people are through the funnel, right, and they've converted them, and after your investors have paid in and, they've gotten their documentation and they've gotten their securities, it's like, you wipe your hands clean, on to the next deal. No, I don't see it that way. I see it where your investors need to be able to come back to your platform 6 months down the line, 9 months down the line, to be able to look at the documents and maybe refresh their memory about what the digital paper trail looked like. Hey, wait a second, I made this payment, but it shows up differently on my statement. All of these questions that we ask every day that we have to remember and catalog and audit for ourselves are all available. And I think it's important that you put yourselves in the shoes of the investor for the journey, because the journey ends only when sort of in an empathetic way, knows when it ends for every other investor that's out there. And to that end, we have incorporated AI bots, really smart AI bots that have learned and that continue to learn not only the language of the industry, but the language of a given offering. So, for example, Jason, to be able to at scale, when you're talking about, how do we sort of help investors or groups of investors at scale? 15 years ago, you might have had 50 investors. You never had the Jobs Act, participating, and that was a big, big deal. Now you have 1,000 investors, and it may not be a big deal. Oh, how come you don't have 5,000? Well, how do you actually have programs in place in your offering where you have small companies raising big money through the retail markets, but they don't have an infrastructure like an investor relations firm to be able to manage the questions that might be coming in from these investors as they're putting in big dollars? So our bots and our human system in these workflows allow people to ask questions and provide answers before they're even asked outside of network. So we're able to assist these investors with asking questions that may be in an offering memorandum, or that might be in an offering circular or PPM, because we've taken that unstructured data, refined it and been able to get those answers out there. When they're more esoteric questions, we can then route those questions for that investor directly to the issuer or the broker in that matter. So nobody falls off the grid. Everybody feels like they're being taken care of. And I think that's important when you're talking about scalability. You can't scale one side of the experience and not scale the other side of the experience. Got to scale it across the board.
Absolutely. And let's talk about those AI bots and the data a bit more. I always say we have assumptions going into a campaign, and the campaign language is a little different than will be used in investment banking. Any type of capital raise, we have assumptions, but we need the data to show us what's working. You guys are looking at the offering docs. You're seeing how audiences are engaging with those materials. You're then able to say, hey, we're getting more questions like this. Let's incorporate this into the materials. Or you're speaking with a new issuer. A lot of these topics get brought up. We need to make sure it's represented there. We need everything in that one specific hub so that, we're not losing people. Maybe they ask, maybe they don't. We found when we add this to the offering page, this type of perspective, we're getting a better response. The analytics are able to show us more and more and more. And I imagine that's where your AI bots come in. Can you speak to us a bit about what's working?
Yeah. That's absolutely correct, Jason. That's a really great overview of kind of what's going on here. So you have a landing page, right? We don't control the landing page. Guys like you that do brilliant marketing and are able to create landing pages on behalf of issuers, put the information which is necessary from a compliance standpoint and also from a learning and education standpoint, whether there's some suitability there for the investor to make the investment. We come in when you click that invest now or subscribe now button. And once you get into our backend workflow, there's still maybe some specific questions, right, about a couple of things here. One is about the technology itself. Like, what am I doing here? What's an accredited investor? What's this? I mean, I want to put in X amount of money, but, I need to understand the rules a little bit better. You can ask those questions and, a lot of information will funnel in from either outside of our system or within the closed system. That's number one. So it's about technology or technical questions about the workflow. Then there may be questions about business questions or transactional questions about the offering that we scope out, and we scope out from the offering documents that have been provided to us. We scrape that data And then we take that data and we structure the data. So for instance, what does that really mean, right? People are like, structured and unstructured data, what does it mean? So if you are an investor and you ask a question, say, hey, look, what was the issuers blah blah blah, something about their balance sheet, what were their earnings, like last year off their balance sheet, whatever it may be. That's all already included and embedded somewhere in that ppm, that 125 page ppm. We can pull that data out and answer the question. We obviously, AI is not 100% perfect, right? You can have 10 humans look at something and make sure that it's absolutely right in the information you're spitting back. But we do disclaim it saying that, look, you should also refer back to that. But if you really need a quick answer for something about, based on the decision that you're going to be making, in terms of whether you want to participate or not, some of those questions can be asked. What does that do, though, Jason? What it does is it saves the phone call to the broker. It saves the phone call to the issuer about that question that's somewhere deeply embedded in those documents and gives you the answer. And I think that's what we're sort of getting at, to be able to assist everyday investors, or who would be everyday investors, with some of these rudimentary answers to rudimentary questions, which are really nested in these massive documents, right? We still haven't gotten over the legalese part of these massive offering documents, but those questions should easily be able to be answered without 10 touch points involved.
Agreed.
And that's where we're able to sort of assist. So you really have sort of a full-scale experience here, not just a transactional side, but also this Q&A, just the breathability and dialogue, which I think is important. And at scale, this is why we need to use bots in conjunction with humans. And it goes one step further. If there's an esoteric question, if there's a legal question, which we're obviously not going to answer, because you need a lawyer, to answer it, your own lawyer or counsel for the company to be able to answer it, or the broker, we are able to route those questions directly out to either the issuer or the broker dealer or whomever they ask, because we have that set up. So no question is going to be end up in a black hole. It's either going to be answered by the bot, by a knowledge base that's connected to the bot, or a human being.
Mm-hmm. And like you said, you want to limit the touch points. I mean, as a marketer, we know there's more conversions later on, but it shouldn't require 10 touch points to get those basic legal questions answered. You won't get 10 visits out of many of the prospective investors. So to be able to have it right there, in the forefront, touch point 2, 3, 8, now they're getting questions sent to, legal, whatever it may be. So it's all managed appropriately. You're getting better results. What about the retail versus the accredited investor? You talked about 506C Regulation D, which allows for solicitation of accredited investors, high net worth, high household income audiences. You talked about Regulation A+, that incorporates retail investors, can do up to 75 million on a, based on your filing there, of course. Would you encourage more issuers to incorporate retail, to use a Regulation A+ filing? And what are some of the differentiators there in terms of the personalization of the offering and how it's represented through your platform?
Sure. The great questions all around. So I'll answer the personalization part for the offering. The personalization is pretty straightforward, right? Everything is essentially the same from a workflow standpoint. What differs in a Reg A+ offering is, as you mentioned, there's no requirement for an accredited investor. As a result of there being no requirement for an accredited investor, the accreditation module, if you will, or step in the workflow is removed. All of the KYC AML modules are still in there. So we still do our OFAC sanctions check, our adverse media checks, our PEP searches, all those things are still done for the benefit of the issuer, for the benefit of the investor, and of course, for the benefit of their counsel and regulators, right? So we need to have that done. I think we take that as a hard line that nobody can pass through. So why go out to the retail community, right? And maybe what's the difference? Should issuers go out to the retail community versus sort of the retail accredited community? I think a lot of that has to do with some business decisions that have to be made by the issuer, what their current standing is in terms of, how long have they been operating? What do their revenues look like? So there's some business decisions that need to be made on that at that level. And I think the number 2 point is that a Reg D offering is an offering where the private placement memorandum does not have to be filed with the SEC. So there's two distinct offerings, Reg D and Reg A+. Reg A+ is a qualified offering, meaning you're registering securities, right? So it's a different path altogether. A Reg D offering is a path where you're sort of circumventing, if you will, registration, but you're providing all of this information and you need to pass muster. There's a very high threshold to do a Reg D offering. You have to have audited financials. You have to have a variety of different things. With a Reg A+ offering, those thresholds are a little bit less. It takes a little bit longer because the SEC needs to review your offering circular. You have to have counsel, competent counsel working on it. So I think there's a lot to be said about which flavor of offering you pick. There's certainly not analogous to each other, if that's what you're asking. I think there's more to do with expense. There's more to do with how mature a company is to be able to do that. And there's risks, like for instance, Jason, just spitballing here, Reg D offerings, right, to accredited investors historically, and there's research that backs this up, when the minimum investment amount is set by the offeror, who's the issuer, to $5,000, $10,000, $15,000 as a minimum investment, you're going to have less chargebacks. You're going to have less drop-offs once the money is in, once people have committed, once investors have committed. There's a level of sophistication, presumably, that the investor has. That's why they're accredited in the first place. And they have to get accreditation paperwork across, right? So there's a bit of friction. We've resolved a lot of that friction programmatically, but there's still things that they need to do. Yes. Right? There's things that need to do. With a Reg A+ offering, issuers need to take note that you might have chargebacks. The ticket price to get in is less, $500 perhaps, $1,000 it might be. You might see chargebacks come across. You don't have higher thresholds or standards of suitability for those investors, like accreditation. So it's easy to get through the workflow, but it's also easy to sort of be like, change your mind. Before you close that offering or before the issuer closes that. So you sometimes do see disputes and chargebacks from time to time. We haven't seen that just yet, at scale, but, it might be because the size of our offerings and the issuers that have come in and the minimum investments amount have been higher, generally speaking. Like our thresholds are about 5,000. We don't set them, the issuers that come in to do. So I think, issuers and counsel and brokers, if they're involved, have to really weigh those types of things. But really, to summarize for you, the real key difference is that one is an offering which is registered with the SEC, and the other one is a Reg D, which is not registered. Unregistered securities being sold, high threshold. Blue sky filings need to be done for Reg D offerings. For Reg A+ offerings, there are no blue sky filings. It's a federal exemption. So there are various things to consider. And we do have some stuff up on our website, and I can certainly send some stuff along. And there's a lot of information available on the interwebs.
The interwebs, it's all about that education. And I think it's, a common question, even speaking with you at the microcap conference and, working with publicly traded companies, that question of, hey, are we going after, institutional, accredited? Do we want to incorporate retail? I know for me as a marketer, it's a bigger undertaking, but it can be scary for issuers of, do we want 5 investors, less? And going back to, 2010, past points in the timeline, is there more power, in the crowd if we bring on thousands of small retail investors? What are we taking on as an organization? So agree, it's absolutely a business question.
Yeah.
I've seen good things come out of retail. I've seen ambassadors and user owners, and even on B2B types of products, individual retail investors really rallying and promoting behind a brand and seen it, produce far more than just the initial value from the investments themselves.
That's a great point.
Far between. It's a smaller percentage of issuers that achieve that.
Yeah, it's a great point too. What is it that the company is selling or doing? If it's an esoteric back-end B2B service, which is very profitable, let's say, sure. It may not be as well understood to the everyday investor, to the Main Street investor, whereas a CPG product, some sort of consumer packaged good, something of that nature, something that's retail, something that's tangible, might have more stickiness, in the street. And if it has more stickiness in the street, if I'm using a product and my friends are using a product and I have an opportunity to invest in I like the product, having an opportunity to invest in that company through a Reg 8 plus platform, you might get a good herd mentality there and a lot of movement, a lot of sort of en masse movement going toward that product, which might be supportive for some sort of a large retail level offering, right? I mean, if a company has a cult following, then it begs the question: hey, should we actually do a Reg A plus offering? Should we do some sort of equity crowdfunded offering, whether it's a CF or an A plus or what it may be? So I think a lot of it has to also do with the companies, what the services are, what the company's providing, and also the second thing is, what is the company's trajectory? They may not know certain things just yet, but Jason, you and I both know that maybe a year down the line, the company has a view of perhaps going public. So that provides, and it doesn't mean that the company will go public. There's still a lot of things to be determined, but that's their ambition. That also provides an exit strategy, an ambitious exit strategy, which can play into the decision-making mix for an investor, prospective investor to invest or not, or retail investor to invest or not. So there are a lot of things that are sort of going on in the periphery that also have to be understood by the investor and also by the issuer. A well-crafted path, a well-crafted messaging, something that you guys do as marketers in your campaign is very, very important so that not only companies stay on brand, but they really stay on topic and are focused with their investment business strategies and their trajectories, transactional trajectories, if you will.
Has to fit into the larger plan. Absolutely. And you guys have built an amazing platform. There's only so many platforms out there. You're talking about all the differentiators and all the points and all of the friction you look to remove with your offerings. I feel there's only a small percentage of startups, mid-stage, microcap companies that are using these vehicles today. It's growing, but where do you envision the industry in 5 years, 10 years? Are these going to be the primary tools for fundraising? Seed A, B, C, IPO later. Is this going to be the norm? Are we going to be hosting these investor conversations online and offline will feel more like a thing of the past? Will this support more of the traditional VC community? Where do you picture things 5, 10 years out?
Yeah, that's a great question. I don't think there's anything that's going to be the norm. And the reason why there's going to be no sort of norm is because the industry is segmented in and of itself, right? There are always going to be institutional folks, VCs that are going to use institutional pathways, to be able to get in first or be able to pick get the pick of the litter, the creme de la creme, however which way we want to phrase it, the best of the best companies, right? There's a reason why the DoorDashes of the world, the Slacks of the world, all these guys, have these massive VCs backing them initially. It's because, there's a tremendous amount of money that goes in and decision-making that goes in at that level. Well, what does that mean for, equity crowdfunding? I think equity crowdfunding will absolutely carve its own niche, have its own place as the norm for equity crowdfunding. The Reg A Plus will become the norm. It won't become an outlier source, of capital raising. It has been an outlier source. Now that it's getting more attractive in terms of being able to attract better issuers, better quality issuers, better quality investors, tightened up the sort of platform in terms of being able to get issuers through a workflow so you don't have drop-offs, all those sorts of things technology is helping us out on. But at the end of the day, good companies with good management will prevail regardless of the ways in which they raise their monies. So what we're hoping to see are two things, Jason. One is, good companies coming in and being able to use, a Reg A plus offering type of flavor or a Reg D offering flavor type to be able to facilitate some of these, capital raises. And number two, the plumbing of financial services industry being a bit more fixed so that, and I can go deeper into that in a bit, but the plumbing of the financial services industry, fixing that plumbing and modernizing that plumbing so that investors that invest and then ultimately become shareholders of these companies are able to exit out into the secondary markets, right? In the same manner without the friction. We've reduced the friction on onboarding. But we need the assistance with the DTCs of the world. We need the assistance of the DTC participants of the world to also assist these investors to exit into the senior exchanges, which have been traditionally controlled by the DTC participants, right? So I've done my piece, being able to control one side of it with the assistance of brilliant broker dealers and issuers and securities counsel. But the other side of that bookend, I think, is where assistance is needed. And I think then you will be able to complete the circuit on entry and exit for a retail investor, being happy that they got out or exited, out on the day of an IPO, as opposed to 3 days later or 4 days later, because the plumbing is such that it necessitates them going through another process to be able to exit out. So we want to make sure that that's there too, and that might also happen 5 years from now. And once that happens, Jason, I could tell you with really some level of certainty that you will have a great uptick, in these types of offerings, in Reg A plus offerings, and even these types of Reg D offerings, essentially equity crowdfunded offerings. It's really it's the end game. It's the exit strategy here.
Once that end game has been achieved, once the investor success stories are there from entry to exit, we need the plumbing, the pipelines to be connecting things and have everything flowing. But once that's there, it's going to bring a lot more of those participants and attract more issuers accordingly.
Yeah, absolutely. Right. Absolutely. I mean, issuers, look, at the end of the day, you don't want to leave a bad taste in your investor's mouth, even though they've come into an offering and entered in and received their securities and just kind of hanging out, waiting, seeing the company doing well over the years or over the months, doing subsequent raises, whether institutional. And the next thing you know, they announce that they're going public. And these people that got in first years before can't get out, can't exit before the institutions exit. And, it's been a problem. And, while the company has made its money and they're very happy that their investors have come in and supported them in the beginning, but their hands are shackled, they're handcuffed in being able to assist those investors in getting out should they want to. The issuer benefited from the initial monies that came in. And the investor should be able to benefit from exiting after the issuer is now, is able to self-sustain and even raise more capital. So I think it's an important part of this.
Now, Mo, for our listeners, for our viewers who are founders, or maybe they're marketing towards investors within one of these organizations, or maybe they're a VC, an investor, and believe these vehicles can support their portfolio organizations, what are the tips? What are the recommendations you would have for them to succeed? I look at it as a series of tests. What types of actionable insights can we provide so that they see more investors come in, they see a larger turnout, they're able to, learn from past findings of these deals that have been live before them? What test would you recommend for listeners?
So I think a good smell test always for portfolio companies is, there's something that we talked about a little bit earlier here, is that, the type of company that would fit, the suitability of a company. We talk about suitability of investors, the suitability of a company for equity crowdfunding. And, you might have, some sort of, semiconductor company or some sort of software company that does B2B stuff may not be suitable because they might not get, retail traction there. They might not have retail likability for the company or some sort of thing. So I think it's important to understand, what the company does, what they do, what their retail following is. I mean, it cuts down a lot on their marketing costs. Not to say that, you guys will still do fine, but it cuts down on their marketing costs if there are ambassadors that are out there in addition to a campaign. It's really important, right? You want to be able to build on the success stories of your customers. So I think it's very important. If you have a customer base out there, mobilize them, right? Mobilize them. You give them a piece of their company if you already have a customer base there. There's a familiarity that's already built into that. To make somebody familiar with something that they're not familiar with is a very hard task to begin with, much less trying to take their money or asking them to invest, right? So that's number one. Number two, find a platform. How could you understand the framework, right? And most VCs and most issuers and most law firms, they all understand the framework. But what I mean by understanding the framework is the devil's in the details. Understand the framework to the point where what would it feel like to be the investor going through a platform like this? What does the research say in terms of drop-off rates? Are you going to be successful? Not just on your campaign, you might get a lot of people, tooting your horn all day long, but until you get those conversions going, just like any campaign, until you get those conversions going and get happy investors from the beginning of the funnel to all the way to the bottom and out of that funnel, it's going to be important, right? So be able to understand that platform, be able to understand the usability of that platform, and be able to understand the compliance side of it, because you certainly don't want to mire your investors in friction, right, on that. So I think those are two key components
That's
that
a
I think would be
fact.
very important.
Absolutely. Mobilizing those customers, finding the right platform, really understanding all of the inner workings there. What about once a raise goes live? How can issuers optimize, whether it's maybe slow right out of the gate, or plateaus at a later point, or even, seeing success metrics, seeing those conversions right away? How can they optimize towards the audiences that are performing best? What are the best tools to even pivot if necessary, and the approach to optimization?
You're not asking a non-marketer or a marketing question. I
You
wish
sound
that
like a
I
marketer
wish
to me with the familiarity. We're talking about
I
analytics,
have, yeah.
but
I could throw some Madison Avenue terms at you. Don't worry about that. But I'm saying in reality, I think, what we provide is a back end. What we provide is something that really needs to stay on brand with the ethos of, of the issuer. So, to give you an example, it's sort of like, let's say, for instance, you are working on a marketing campaign for an issuer, and you have a well-branded, well thought out landing page. Everything is all set up, stories there, everything is there. We want to make sure when they click that button that it coincides, right? That the brand, the logos, all those things coincide. Because the idea here is that as somebody in our game, in terms of digital, if people are moving from one place to another place to another place within ecosystems all the time, they don't even know it sometimes. And I think by maintaining integrity and brand integrity, for that matter, I think will help facilitate a lot of that. It'll help facilitate and keep those conversions up and keep familiarity up. Familiarity is really, really key here. There's a lot of noise in the industry, so you want to be able to create familiarity even when you go from the marketing funnel to the transactional funnel.
yes.
There needs to be familiarity there so that there is not apprehension in falling off.
Absolutely. And as we begin to wrap up here, any tips, any examples towards scale? You're finding those audiences, you're seeing the performance, the familiarity is there. How do you take it from 10 million to 75 million raised?
I think selecting the right vertical, selecting the right places to market. One of the reasons, Jason, we didn't get into marketing, it's an art and a science. So what we tell prospective issuers and broker dealers, if they're asking us, hey, do you know any marketers, or can you guys do marketing? We're like, we know some marketers, hint, hint, and we don't do any marketing. But quite frankly, don't do sort of full scale blue sky, everything under the blue sky marketing for a niche product. Right, find the areas to put your marketing dollars in specific, media, in specific areas of various different verticals where you think there would be a crossover. What we're trying to do is cross-pollinate, right? We're trying to make sure that there's some sort of level of cross-pollination. So I think it's very important to be hyper-focused. Marketing campaigns, the best marketing campaigns, I think, are the most genius part of any type of offering. For me, what I've done, Jason, I've built a platform along with my engineers. We built a platform with years of knowledge, and it's static. It's there. It's static. It's dynamic to the extent, how it's used. What you guys have to do is review the landscape and iterate over and over and over and over again, right? So for me to speak about that would be a genuine disservice to your industry without knowing anything. But I know that what I can do is piggyback off of what marketers are doing and how they're assessing the brand and how they're sort of taking the temperature, if you will. I'd like to be able to keep the temperature the same and make sure that it doesn't defile the experience of a prospective investor.
It only happens with that strong offering page, the transactional technology, the personalized experience.
It actually makes our lives easier.
It's a collective for everyone. Like you said, all of our lives are easier with the investors and the issuers at that focal point, but with, compliance, accountants, everyone coming in to make this all happen.
You know what the beauty is? The other cool thing, Jason, is that these are general solicitation offerings, right? A Reg A Plus is a qualified offering where it's, all the securities are registered. So you can put that, we can, as a tech company, we can put that out there, we can put that URL out there, we can put that link out there to whomever. So we would, intelligently use our own distribution channels. We're not marketers, but we can talk to other marketers. We can talk to other people in the network.
Yes.
To put that out there. And that's part of the beauty, Jason, about this sort of tail effect of, this long effect of using the people in your community to further, motivate, and galvanize the community to be see like, okay, you know what? They'll tell you, the proof's in the pudding. They'll tell you if something is off about a product or a company, the masses will speak. So I think it's important to be able to gauge the temperature of that, but also use the basis of these offerings for general solicitation. You can put them out there and get good traction if you're looking in the right spots.
Absolutely. And continue listening, continue seeing what's happening with the market. I mean, we could spend a whole episode just on that, but want to be respectful to your time, want to cue you up for final thoughts and to point the audience, where can they go to learn more about Equidify? I know we're both going to be at the Reg A conference here in June 2024. Definitely invite audiences to speak with us in person, talk to Mo. He is a wealth of information here. But Mo, where can they go online to learn more? And what do we want to leave everyone with today?
Yeah, so you can go to www.equidify.com. I'll spell that out because it's a funky name. EquiDeFi.com. You'll see a wealth of information there about, how these offerings work, how our platforms work, what our pricing structure is. It's very, very transparent, which is really cool. And the tip I would leave for all the viewers is that if you know somebody, right, this is not even a self-pitch. This is more about education. What we're trying to do here is actually, number one, educate the community. I think people feel empowered when they're educated, and then they can make much better choices, whether they want to use our platform or whether they don't even want to go down that road or something else. When you start educating yourself, once you get into a particular system, it makes it more difficult. I think when you educate yourselves initially, you have more choices and you can make better decisions. So use our platform for education, about what these offering types are like, whether it's suitable for you or for somebody in the community. And we'd be happy to answer any questions that you have and happy to help you out. And if you're at the Reg A conference, definitely stop by, see me or Jason. My CTO will be there as well. So if you're a tech head, you'll be able to get your thoughts out there too.
There you go. I would take Mo up on that offer. Head over to Equidify right after listening or after viewing today. Mo, thank you so much for taking the time to do this. Enjoyed every moment of the pod and look forward to collaborating further.
Jason, it's always awesome speaking with you. I feel free when I talk to you. It's awesome. So it's great. I will see you on the 20th of June.
All right.
Thank you so much for having me.
Sounds good. My pleasure. Thank you, everybody. Pleasure having you on today.
You got it.